Hi, great day. Welcome to the Hidden Monkey Daily Update for Wednesday, October 8th. So today was a really neat day for the market, especially if you did golden geckos. Why? Because we bet it'll stay in a range. So today the market popped up, volatility, as you can see here. I don't know why the tip looks like this, but I know it shot up. We closed at 196.64, which is actually this where this pink line is right here. So we actually closed up here. I think it drew it bad for some reason. But anyway, I'll try to see if I can fix it. So IV rank collapsed. This is great for us. As you can see, it went from here, it was as high as here yesterday, and it dropped. There's a nice vol collapse there. So premium came in. Premium came in and we made some money. Now look at your unbalanced volume. See this low right here? It was higher than this low right here, and it bounced up. That signals, usually it signals an upward trend. Look at this low. It's a lower low and a lower low. That's a downward trend, right? Okay. Yeah, bounced back up right here, and then it just kind of kept on going. So the trend has been down, but we'll see if this corrects it. Like I said, I don't really care what direction it goes. I mean, I don't know which direction the market will go. All I know is I'm betting that it'll stay between the one standard deviation lines of based on how many days expiration I have. So depending where that is on the October expiration versus the November expiration, kind of depends. All right. So basically, my current positions, as long as I stay above 190, this line right here, this put I have a put at 190, and I think my closest call is 205 all the way up here. So as long as I stay in that range, I just wish I should have put on more contracts. I would have made more money, but oh well. I should have taken advantage of this high IV right here. Okay, even if I skewed it to the downside, like for example, today's a great day to sell calls. Why? Because the market was going up. Okay, so the market goes up, you can collect more on the call side. So you can say to yourself, hey, look, the high was 201.90, and maybe you can place a bet saying, hey, I'll bet that where's 200 right here, right? You can say, hey, maybe by the end of October it won't come back to 200, or maybe you can do the same thing by November expiration. It'll stay in that range. Um, just kind of depends how aggressive you want to be. I'll show you what I mean in a minute. Slow stochastic is kind of flattening out right here. Okay, so let's look at the ES real quick. Um, okay, here we go. Okay, let me I'll zoom in a couple times. Here we go. Okay, so stochastic is just nice. It's rounding out, nice support bottom here. It's a good sign that a market will come back again. See, again, I don't care. I would love for it to just kind of up, down, stay in that range. That'd be perfect. But basically, it looks like the same chart. Okay, and this is after hours, so it's kind of rebounding, and well, now it's negative, basically flat since the close. Okay, so what you could do in Indo now, let's look what that means. Now IV rank collapse, so you're not going to be able to collect as much premium. But let me show you what I mean. Okay, see, so look, I have a lot more puts on than calls, so I think I might want to put on something here. Here's what I mean. You can go to choose strategy. Let's go to, well, let's just do a basic golden gecko and see what we can collect here. Okay. On a basic strangle, you can collect $1.32. And I know since vol collapse, that's not going to be 19.8% of the expected move. And I'm pretty sure about that. Let's go check. Go to our trade page around here. Where's our trade page? Okay, let's just look real quick. Here we go, trade page. Let's look at November, 44 days expiration. Hold on. Filter off, spread single. Okay, they actually added this new filter right here. Actually, it's pretty neat. Oh wait, I'm sorry. I need to look at the SPY. What am I doing? Okay, here's the SPY. No wonder it looked weird. Okay, here we go. So I can close it. I'll just leave it for now. Don't worry about that for now. I just kind of want to show you what we can do for the November It's a $8.347 expected move. So 8.347 expected move. 8.347 times 0.198. You want to collect $1.65 on a triangle. We're only collecting $1.32. I knew it wasn't going to be enough because of the vol collapse. But let's take a look at how much you can collect. So if I click, look, on a call, you can still, of course, collect more money on the puts. But what I wanted to show you was, let's do it. Let's bring the strikes in real quick, and maybe I can zoom in. Okay, so, let's see what a golden gecko could do. Yeah, you only can collect. See, you only can collect 15 cents out at the 207, right? But if you're betting that the market will stay in that range, here's a 200, right? You could actually. Here's what I mean by skewing it. You could skew it to the downside. So watch this. Oh, and by the way, if you have a smaller account or you want to take less risk, keep this at 5. A true golden gecko is when you move these wings out to this 2 standard deviation line like this, right? So you can collect 88 cents, which is, which is great on a, in this case. What you could do is, let's say you want to move this call position down to the 200 area so you can collect more money. So this is what I call skewing, okay? And so let's say you're bearish. You go, okay, well, let's say the market is due for a correction. So you go to your charts, and here's what people ask me, well, how do you make it? Do you just put on a golden gecko and manage? Yeah, pretty much. But you can also look at the charts, and I use that to make my decision a lot of times. Like, look, I'm looking at the charts, and I'm looking at OBV cross. It's red. This is red, so that's not a good sign. It's usually a bearish sign, but it's on its way up, and it's done it before, right? Okay, so but you're betting it'll stay in the range. Well, where are we in that range? Well, we're at the bottom here, so there's risk. Yeah, there's risk to the downside, but there's also risk to the upside. So, like, if you had to do it, I'd say, oh, Mark, I'd probably still skew it to the bearish side. Okay, um, so how would that look? Well, go to your thing. I said, okay, we'll move these things. What if we move it? Well, I'll show you what Karen does, okay? What Karen does is she just looks at the SPY and she assumes the market will drop 100 points, which is 10 points. So if I close at 196, right, 10 points is 186. And then she'll take 12% below that if we're in a high IV rank environment, which we're not yet. Okay, so here's what that looks like. 196. 10 below that is right here, right? That's if the market drops 100 points on the ES or the SPX, it'll drop to 186. Okay, then she takes 12% below that. This brings her to like the 95% out of the money line. So if you go like this, click on percentages, and watch, move the strikes down to that says around 90 to 95%. Look, okay, that brings us down to what, 183. Okay, if you want to go more, you've wanted it to 95%, click about 2 more shots. See, that's down here already. You're selling the 180 put, which means if you look on your chart, what she's betting is that the market will stay above 180 by this expiration date. Okay, well, where's 180? 180 this is 188. I can't even show you one. Here we go. I'll zoom out. I gotta zoom out a little bit to show you 180. Yeah, 180 is right here at the very bottom. See, so she's betting it'll stay. It won't go below this. She's betting it'll stay above here, 180, by the November expiration date. What are the chances of her being right? 95%. Okay, so we can collect $1.78. Well, not quite. I mean, okay, so that's just okay. This is a whole golden gecko skewed to the downside. So this is an interesting golden gecko because look, if you bearish on the market, you're fine, but you're worried about the upside. Look how far you could skew it. All right, so look what I did. I'll start all over real quick. Keep it at 5, right? Start from the beginning. Go to Iron Condor, right? All this is set. 5 strike wides, right? Click on go. Now I'm gonna move these to the 2 standard deviation line, right? To simulate a true golden gecko, right? And if you want to go by percentages, this should be like, yeah, like 2% or less. We can even bump this out so it's 2%. There you go, 2%, right? Now, from here, just skew it by moving your strikes down till this shows like 95%. So if I skew it, watch what happens. 1, 2, 3, 4, about 5. I moved it almost 5 strikes down. Okay, I can't even do 6. Okay, perfect. 95% out of the money, right? Now look, click it off, right? 180.21. See, the neat thing about this trade, I might do this small. I can click $1.42 on the call side. I'm only collecting 63 cents on the put side because I'm so far out of the money. The reason why I can collect so much money on the call side is I'm a lot closer in, okay, on the call side, and the market went up. So the market goes up, you can usually collect a little bit more on the call side. Well, it gets richer, right? You know, it gets more expensive, which means you can sell it for more. Now, why do I say this is interesting? Well, you're betting that the market will not make a new high. See, the high was 201.90, almost 202. Okay, and that was the high before this started. So this bet right here, you're betting that the market will stay above 180 but below 201, which is right about here at the end of this November expiration. Pretty good bet, and you can make pretty good money too. Okay, $1.77 per contract. That's $177 a contract. And here's your risk. Oh, this is wrong. You know why? Because I put on more positions. So this is that thing where if you put on more than 5 positions in a week, it's a day trading pattern. It screws it up in an IRA. But so that's not really right. So it's kind of a bummer. But that's not true. But anyway, let's say I wanted to reduce that thing. I could just move this in, okay, to the 1 standard deviation line, or keep it. If I keep this at the 2 standard deviation line like this, like right at 1% out of them right here. If I move this, actually, if I move this out to 1%, I can collect more probably. Don't know, maybe not. No, not. Okay, but if I want to reduce my risk, I don't think that'll work because 6 strikes 1. Okay, so what I'm looking at here, see, look, from here to here, how wide is it apart? I know, see that number right here, 6 strikes wide. So I just move this to 6 strikes wide. From here to here is 21 strikes apart. Okay, shoot, I'm sorry about this. I don't know why it's doing that. That's actually wrong. But anyway, I kind of wanted to show you the concept on how you could play with it. All right, now what if I'm wrong? Real quick, and the market goes higher and starts testing my 201 call. Okay, well, how do I look at that? So look, see, I know it's the November expiration 2-1 call. So all I do is, as I'm watching it, go to see the November, go to the 201 call, which is this. Here's the call side. Find the 201, and all you're gonna do is keep an eye on this probability out the money number. Okay, it's at 72%. Let's say that drops to like 60%, 65, 60%. That's too risky. Then I'll just move it. So close this one and roll it to a further higher strike price. And that's pretty much how I adjust stuff before I get in. I don't want to wait till I'm in the money. So right around here, like 60% up, like at 198. If I had the 198 call in, I'd be real nervous. Because look where there's, you know what I mean? If I had the 198, I'd be nervous. Why? Because look where we're at. I'd move it already. Okay? So that's how I look at things and how I adjust stuff. So for tomorrow, just put on the positions, man, and make sure you're placing them at least 1 standard deviation out of the money, and then protect your trades. Get out of trouble before you get into trouble is all I'm saying. All right, that's pretty much it for today. Hope you guys had a good trading day. Any questions, give me a shout out. Thanks.